Okay, the very first thing, when we talk about super, when you die, your superannuation benefits turns into death benefits. So when you're alive, your super, everybody's got an interest in their super. It's what we call superannuation interest. On death, those super benefits get converted automatically into death benefits. So we're talking about death benefits here. What everybody should know is that on death, the death benefits need to be cashed out of super within a reasonable time, or as soon as practicable. And that's usually within 3 to 6 months, depending on the circumstances of the super fund. If there's a beneficiary that you can't find, that's one reason why it can't be cashed out yet. So that could take a couple of years. But if it's pretty straightforward, you know who the beneficiaries are. The assets are comprised of probably cash and some shares. That can be sold off pretty quickly, and they can be cashed out as a death benefit. The death benefits are governed by your trust deed. Your deed will tell you how you take out those death benefits. That can be taken out in the form of a lump sum, a death benefit pension, or a reversionary pension. I'll be talking about each of these things as we go along. Let's go back to the question, what happens to your super when you die? Okay, this depends on a number of factors. What does the deed say? Each of you have got a self-managed super fund. You've got a document called the deed, superannuation fund deed. That tells you what happens on death, what happens to your super. There's a lot of clauses there, but there are clauses to do with death. The second factor is a binding death nomination. I'll be talking about a lot about this particular issue throughout the presentation. And is the fund in pension mode, and does it automatically transfer to your dependent upon death? I'll be talking about that as well. The trust deed. Always review the trust deed. So obviously, this is where we come in as your accountants and lawyers as well. The lawyer needs to look at your trust deed. What does the deed say about death benefits? The deed needs to be updated on a regular basis because there are changes, as you know, with superannuation, and the clauses need to be updated to reflect those changes. Binding death nomination. What is it? Okay, it's purely a direction by yourselves as individual members of a superannuation fund, telling whoever is the trustee of that fund, the remaining trustee of that fund, where you wish your death benefits to go to. Now, binding death nominations, they need to be drafted in a certain way. Well, they are drafted. There are templates around, but normally solicitors can draft a special one that's tailored to your needs. But they need to be valid and effective in order to hold water. Otherwise, if they're invalid, you've just wasted time in doing the binding death nomination, because what I'll be explaining as I go on is that your super may go to unintended beneficiaries. Okay, so what makes a binding death nomination valid and effective? It must be in writing. It has to be signed and dated by the member. It has to be witnessed by 2 witnesses, independent witnesses. And those witnesses can't be whoever's going to be benefiting from those death benefits. So I've seen over the last half a dozen years that people do their binding death nominations. Say, for example, the husband nominates the wife to receive 100% of the death benefit. So he signs it because he's the member. But sometimes I find that one of the witnesses is the wife. That's invalid. Because the law says, superannuation law says, it has to be 2 independent adult witnesses. The wife is not, first of all, the wife is benefiting from the super. So how can she be an independent person? The same thing with children. If you're nominating children to receive the death benefits and they're witnessing, that's also invalid. So, and I'll be demonstrating how a bond and death nomination can be invalid, because I'll be talking about some cases in 2 or 3 slides down. Who can you nominate? Okay, it has to be a dependent. A dependent for superannuation law purposes. This is what we technically call SIS dependents, SIS dependents. They are a spouse, a legal spouse, a child of any age, so it can be anybody under 18 or over 18, an interdependent person. What that means technically would be, say, a son and mother living together in the house. You know, they're looking after each other, and they're interdependent of each other. And a financial dependent. So if you've got somebody living with you who's financially dependent on you, he or she can qualify as a dependent for this purpose. So therefore you can nominate that person to receive your death benefits. The other person that you can nominate is what we call a personal legal representative. That person is a person who, if you do a will, you normally nominate an executor in the will, or the trustee of that will. If there's no will in existence and you pass away, what happens is whoever is close to you, could be a family member or could even be a friend, can go to the courts and appoint themselves as an administrator of your deceased estate. So that person will become your personal legal representative. So, and if that's the case, if there's no will, that means that the laws of interstate come in. Not interstate as is New South Wales, or I'm talking about interstate, that's what it's called. You've died interstate. Then you've got interstate laws coming in. And what that tells you is that your assets get distributed in accordance with a certain formula. There's a few traps that you need to be aware of when we're talking about bond and death nominations. If it's not valid, that means it's not binding. So, for example, if you've done a bond and death nomination notice and there's a witness signatures missing or a date missing or something like that, that renders the bond and death nomination invalid. If that's the case, it's not binding on the trustee to follow what you wished for. All right, so if I'll give you a clear example. If a typical mum and dad self-managed super fund, the husband does a bond and death nomination, probably nominates the spouse as a recipient of the death benefit, and that spouse is also trustee of the fund. So you've got 2 trustees. So in the typical husband and wife team, they will have their 2 members, and as the rule says, each member has to be a trustee and vice versa. When you've got a company trustee, they're directors of that company. All right. So if one of those people die, whoever is in control of that fund will be the remaining trustee or the remaining director. So if you nominated your children to receive your death benefits, but your bond and death nomination is invalid, well, guess what? The wife, who's in control of the fund, will have discretion where the money goes. And I'll be demonstrating that in one of the cases. You follow? If non-dependents have been nominated, the trustee is not bound to follow the nomination. So remember how I said, who can you nominate? Can either be a dependent or a personal legal representative. If you've nominated somebody else who doesn't fit in one of those descriptions, that nomination becomes useless. Where a nominated beneficiary predeceases the member, then the notice becomes irrelevant in that case as well. So if the husband nominates the wife to be the recipient, but if the wife predeceases the husband, what use is that binding death nomination? Now, you can tailor the binding death nomination to say, in the event that the beneficiary predeceases me, so I'm the husband and my wife predeceases me, I can nominate my children to receive the death benefits. So, but it has to be in writing. You have to say that. And if that happens, so the binding death nomination should be updated. All right. So just because you do a binding death nomination, you're stuck with it. You can revoke it and update it. It's like a will. You can revoke your will and update your will. If you've nominated a financial dependent, you have to be careful here, because financial dependent can be adult children over 18 years of age. Remember how I said one of the dependents can be a child of any age, right? So that fits under the CIS definition of a dependent. But if that dependent is a child of yours, but he's over 18 years of age, and he's normally, that child is normally a financial dependent. Now, there are children who are between 18 to 25 years of age who are still financially dependent on their parents. So they're okay, but if that's the case, if the child is over 25, he's not a financial, he's classified as a financial, is independent of the parents. And in that case, that financial dependent, when he receives the death benefits, there's tax applicable at 16.5%. So if you've got $1 million fund and you've nominated a financial person, the dependent, independent adult child, for example, $165,000 goes to the tax office. All right, so that's one thing you need to be really aware of when you're doing your binding death nominations and you want the recipient to receive your death benefits. Now, what I need to explain here when it comes to tax is the tax only applies on the taxable part of the super fund, of that death benefit. When each of you have got a super fund, whether it's self-managed super fund or not, it doesn't really matter, it's super, you'll have two components of your balance made up of taxable component and a tax-free component. All right, so the tax-free component is essentially contributions that have been put into the fund and you didn't get a tax deduction for. And then you've got the taxable component, which are the taxable contributions that have gone into the fund and tax has been paid at 15% along the way. So if at the end of the day that $1 million fund is made up of $850,000 of taxable components and $150,000 of tax-free components, the tax-free component that goes to the adult beneficiary pays no tax because it's a tax-free component. It's just a taxable component of that death benefit, which is the $850,000, is taxed at 15%. So the strategy is, this is where we come in, people like myself who deals with super pretty much 60-70% of the time at work. There are strategies how you can put certain strategies in place, how you can convert from taxable component to tax-free component as much as possible over the life of your working journey, right? But these are strategies that can be simply need to be talked about, discussed. Everybody's circumstance is different, but you certainly can convert a taxable component within a fund to a tax-free, and that normally happens when the members can start receiving pensions from their fund. So they take money out, they can recontribute that back in as undeducted contributions, and you've changed the mix between the taxable and tax-free. But I'll be talking about strategies. We'll be doing more workshops in the new year, and I'll be talking about a lot of this stuff, strategies, estate planning, and I don't think it's the right forum here because of the time constraints, because it does get a little bit involved. All right. But there are ways how you can reduce the tax liability. Advantages of a binding death nomination. Well, it gives you greater certainty. So if you do one of these nominations, and it's done in the right way, it's valid, everything is hunky-dory. That gives you a level of comfort that you know that your super is going to go to whoever you want it. All right. It should complement your estate plan. So if you do your wills, that covers your other assets, whether it's in your own name or maybe you might have assets in family trusts or companies. If it your bond death nomination should tie in with whatever you're doing outside the super environment. Reduce risk of challenges. When you do one of these things, it can't be challenged by disgruntled or aggrieved beneficiaries. Whereas if you do a will, that can be challenged. Pratt, another one, a billionaire. He had an affair with a younger woman. Good on him. But you see what I mean? There was a child. There was a child there, and so they put in a claim, and they received $10 million, I think, but they succeeded. Whereas if it was the binding death nomination, it can't be challenged. But that binding death nomination, as I said, has to be pretty much valid and effective. Disadvantages of a binding death nomination. It can create inequity. So if a member has died, say, with an inappropriate nomination, for example, this may be applicable in such cases as a divorce or a breakdown or of a de facto relationship. For example, the member may separate from the spouse who was nominated under a binding death nomination to receive the benefits, but fails to revoke the binding death nomination before his or her death. If there was no divorce, the trustee is obliged to pay the benefit to the separated spouse. Right? At that point, it's just a separation, it's not a divorce. Once you're divorced, the binding death nomination should be revoked and replaced with an updated one. But in that situation, in a separation, and you've nominated your separated wife, to receive the binding death nomination, and you die before she does, well, she's got every right to claim that death benefit. Sometimes binding death nominations can become inflexible. If your dependent circumstances have changed, like an adult child faces bankruptcy or other legal challenges, or has died before you. For example, if a binding death nomination specifies 50% of my super goes to my son and 50% to my daughter. I'm not married to our friends, but I'm talking about pseudo relationships here. And if my daughter dies before me, well, only 50% will go to, well, the 50% that I've nominated goes to my son, but what about the 50% to my daughter? She's predeceased me, so where does that go? So it can become inflexible because, as I said at the start, binding death nominations, you can do one, specify who your beneficiaries, but you need to have some flexibility built in. That's why you need proper people to look at these things, like a lawyer who specialises in self-managed super funds, and also the accountant who also works in the self-managed super fund arena. The tax laws may change. Was the binding death nomination in place, and the allocation of benefits that was tax effective then when the binding death nomination was prepared has now been ineffective by the time of the member's death. For example, a dependent child at the time of the binding death nomination was drafted is now a non-financial dependent child, therefore is subject to tax. So if you nominated a child under 18 years of age, say a 17-year-old, now a year later he turns 18 and he's financially dependent, the question is, have you left that bond and death nomination in place? So if you die in the meantime, well, what happens? Well, the death benefit goes to him, but he'll be taxed at 16.5%, like I said before. So circumstances change, meaning that your documentation should change with it. That's the whole essence of that point. What can go wrong? I love these cases. These cases are actually true cases, and they're not fictitious. They've happened in the last 10 years. So the Katz and Grossman case, 2005. Oh, what happened there? The second case happened just last year, and McIntosh happened this year. And I'll go through one of these now, I suppose, and you'll appreciate where I'm coming from when in respect to this topic. The Katz and Grossman case. Okay, in this case, you had a husband and wife being having a self-managed super fund, and they were individual trustees of that fund. So remember the old rule: you need to have a corporate trustee or two individual trustees to run a self-managed super fund. All right, so in this case, they had a self-managed super fund. They didn't have a company as a trustee, but they had two individual trustees, right? Husband and wife. The wife died. So in that situation, he was the only remaining trustee. To fit within the definition of a self-managed super fund, you need to have two individual trustees. So when you only got one trustee, you need to appoint another trustee. He appointed his daughter, Linda, I think her name was, yeah. So now it's back to two individual trustees. When he died, subsequently, Linda, who's the surviving trustee, has to appoint somebody else to be co-trustee with her. So she's nominated her husband. Now this is where it gets interesting. The father who died specifically wanted his daughter and his daughter and his son to benefit from his super. All right, so he's done his will. His intention was always to give that super to 50-50. But crafty Linda, together with her husband, thought otherwise. She was in control of the fund with her husband. She didn't see eye to eye with her brother. So guess what? She took the super, left the brother, basically shafted him. So what did he do? He had to go to the courts and fight it. The court upheld the decision. She was right. She had every right to take that super. She was the control of the fund. So when you do your estate planning, you need to think about who controls the fund after you die. So if you've got a company as a trustee, the control is who are the shareholders of that trustee company. You know what happens when you've got a company, you've got shares. You know, even though it's one share each or 5 shares, whatever, they're important pieces of paper, because the shareholders control. Basically, when you've got shareholders, they nominate themselves as directors of their own company, and they control the company, and therefore the company is the trustee, and they control the fund. Right. So you know, think about your own specific self-managed super funds. Who the trustee is. Most of your funds are you've got company trustees, so therefore you'll be the director of the trustee company and the shareholder of that trustee company. But if you depart from this world, who's the remaining director or shareholder? Normally it's the wife who'll be the other shareholder. But if you don't have, if that wife has also departed, who's going to come in? So in this particular case, the Katz and Grosvenor is a very high-profile case in our world, in the superannuation fund arena. That was one of the first cases that came to light, that started talking about these issues, about who controls a fund and what have you. I Apollo Hesford versus Conti. Here you got two members and individuals of this fund who were Mrs. Conti and her estranged husband, Mr. Conti. So you got husband and wife who are not talking to each other. They're estranged. Mrs. Conti died, and her will appointed two of her 4 children as her executors or personal legal representatives, namely Rosario and Grace. Rosario Apollo and Grace Hesford. The will stated that she wanted her super to go to the children, to the 4 children, for death benefits. What did I say at the beginning? Your super is not governed by your will. So in this case, what happened is that Mr. Conti, who was the other trustee of the fund, because Mr. and Mrs. Conti, they had a super fund, so they were trustees. Again, individual trustees. So when Mrs. Conti died, what Mr. Conti did was appoint a company to be the trustee, and he'll be the sole director of that company. So you can have that situation. You can have a company, and you can be the sole director. That's a very common thing. Again, this is all part of strategies and planning, and particularly when you don't have a spouse or something. So you would have a company's trustee, and you'll be the only director of that trustee. So he's appointed a company called Augusto Investments Proprietary Limited as the new fund trustee, with him being the sole director. He has control of the fund now, completely. So when the fund was established, Mrs. Conti had signed a non-binding nomination. This is one of these nominations that existed in the past, where you normally specify, when you become a member of the fund, you normally specify who you want your benefits to go to. That's what we call non-binding, because in those days, you didn't have to have the 2 signatories, 2 witnesses and that type of thing. So it's what we call non-binding. So when a nomination is non-binding, the trustee, being Mr. Conti, doesn't have to follow that. Right? Subsequent, a few years later, she did do a binding death nomination, and she did, whilst they were still together talking, she did nominate her husband to be the recipient. So there is a binding death nomination in place. So she did nominate the husband, but what she didn't do when they became estranged, she didn't update her binding death nomination. So guess what? He took the super. The 4 children got left out. But even if there wasn't a binding death nomination, he still would have got the money because he's in control of the fund. All right? Macintosh, earlier on this year. The deceased member, the son, died without a valid will, and there was no binding death nomination. So you got no will and no binding death nomination. He had super in about 5 different areas. So he had an AMP fund, a colonial fund. So he had half a dozen super funds. So but he lived with his mother. So the mother had to apply to the courts to become an administrator of his deceased estate, because you need somebody to run the estate. The court appoints one for the deceased person, and normally be whoever puts up their hand. So the mother put up her hand, and she became the administrator of the estate, of the deceased estate. So what she did is write to each of these super funds, AMP or whatever, to pay the death benefits out, and it goes to the deceased estate, and she took the money because she thought she had control of as an executor or an administrator. She thought she had control. But then comes the father, who's still alive. He's saying, hang on a minute, there was no will. So what the mother should have done as administrator, she should have followed the intestacy laws, the laws of the state. So each state in Australia has got the intestacy laws. In Victoria, the personal chattels of the spouse gets distributed first. Then the first $100,000 of the estate gets distributed to the spouse. Then 1/3 of the remaining estate to the spouse, and then 2/3 of the remaining estate to the children after the spouse has received her entitlements. If there are no children, then you start talking about brothers and sisters, cousins. So there's a formula, there's a whole stack of how the estate gets distributed. So that's in the case when there's no will. So you really don't want to be in that situation where you have no bond of nomination and no will. Your assets will be distributed, but will be distributed in this fashion. So under Macintosh and Macintosh, that's what's happened. So the father came in and said to the judge, "Well, hang on a minute. My son died without a will and without no bond of nomination. So the laws of the state should be followed." So the mother had to repay back to the deceased estate, I think $400,000 worth of super, and because because the father was able to share in some of that money. So in that case, you had $80,000 of non-super assets, which he got some of that through the intestacy laws formula, but the super went to the mother because she took it. She benefited $400,000. So the father, after he went through this rigmarole through the courts, he ended up with $200,000 plus. Right? So it's very interesting. I thought I'll bring up these three cases because this demonstrates what I'm talking about. It gets you, and also I hope it gets you guys thinking as well. Should I see my lawyer tomorrow? Type of thing. Actually, no. See my accountant tomorrow because the accountant is really the driver of this. The lawyer doesn't know anything about your self-managed super fund. We have to advise, how you're structured. Obviously we have to provide all documentation, trust deeds and that type of thing. But yeah, it's really the accountant, whoever is your professional advisor at CS, is the driver. Auto-reversionary pension, what that is if the deceased member had a pension, an existing pension before he died, and he's nominated his spouse or dependent to be the recipient of that pension, that's what automatic means. It automatically reverts. So on death, his pension continues on to the wife automatically, because the pension documents that we do, we always nominate the spouse to be the recipient of the pension. You can nominate your children to continue receiving your pension if they're under 18 years of age, or if they're between 18 and 25, they're financial dependent. But once the child turns 25, that pension has to stop. He has to convert that pension back into a lump sum situation, and therefore he potentially could be taxed at 16.5%. So you have to be careful with this. Who do you nominate? But normally, 99% of the cases, when we do pensions for clients within their self-managed super funds, we nominate the spouse. So the husband nominates the wife nominates the husband. And because both husband and wife receive pensions, so if the husband dies first, his pension goes to the wife, and vice versa. So that's what auto-reversionary pension means. I started talking about taxation of super death benefits. Death benefits are paid to tax dependents are essentially tax-free. Now I've slotted in here a terminology called tax dependence. What that means is simply financial dependence. All right, so this is the funny thing about super. You got a definition for under the Superannuation laws, who's a dependent, and then you got a definition under the Tax Act, who's a dependent. And then it does change slightly. and normally it's around the children. Because under the CIS definition, any child can be a dependent, but under tax, that child who's over 18 years of age is normally a financial dependent. So who's a tax dependent? A spouse or former spouse, including same-sex couples, a child under the age of 18. It can also be a child 18 to 25 and financial dependent, an independent person of the deceased, like I said before, a mother and son situation, or mother-daughter situation, or father and son situation. They cohabitate together. Any other financial dependent person, so they can be tax dependent. So if they are tax dependents and the death benefits are going to them, it's tax free, whether it's taxable component or tax free component. The tax dependent can receive the benefits by way of a pension or a lump sum. All right, so when you die, and the recipient can decide how to take that money, as a lump sum or as a pension. Lump sums can only be paid to financially independent beneficiaries, including adult children, and may be subject to 16.5% tax. So once a child becomes of 25 years of age and financially independent, he can't receive as a pension. He can only receive as a lump sum, but he gets taxed at 6.5% on the taxable component of that death. Some important factors to think about when it comes to super and estate planning. Always take note of the deed provisions. Yes, you do employ us to do that for you, so yes, we do that, and your lawyer should do the same thing. Because it's really the deed that really governs, that tells you, where the money goes. Is there a binding death nomination? Has it been completed and executed properly and therefore valid? Who are your dependents who you wish to nominate? Your executor and the nominated beneficiary via the binding nomination notice should be the same person. Because if there are two different people, you can have conflicts. This is where conflicts arise. So ideally, you will want your executor of your will possibly to be the nominated beneficiary of your in your binding death nomination. Because otherwise, if you don't, you can always you end up in a situation like a Katz and Grossman or the Conti case, and similar cases that have transpired over the years. Consider who's going to be the shareholders of the corporate trustee of the fund. Ideally, should be the same people as the executor and nominated beneficiary. Ideally, you have no problems. Consider life insurance. As you may well know, you can have life insurance within the fund to boost up the death benefits. So if you've got $1 million fund and you've got a $500,000 policy, the death benefit essentially becomes $1.5 million. Consider tax implications. That's the 16.5% tax I was talking about before. Consider that. How do you get around that? Once you die, you die, but whilst you're alive, you can put strategies in place, as I've mentioned before. You can convert the taxable component of your fund into a tax-free component. And one of the best ways is when you're in pension mode, when the fund is in pension mode, start paying a pension, you can draw monies out and recontribute that back in as tax-free contributions. Consider withdrawing all or part of your super benefits before death. It's reasonable. If you take all your money or most of your money out of your super, you can do whatever you want. You can gift it. Who's going to challenge you? Challenges happen on death, after death. If you've got a binding death nomination and it's pretty much watertight, well, as I said, you can't challenge that. But if you nominate your personal legal representative in your binding death nomination to receive the money, the executor to receive the money, the executor has to follow the terms of your will. as I said before, your will can be challenged if you left somebody out. Right? So if you nominated A, B, C, and there's also D and E beneficiary, and you left them out, they can mount a challenge. But there has to be reasonable grounds. Nobody can just challenge for the sake of challenging. They have to have some reasonable grounds. But if you take your money out before death, you can do whatever you like. You can gift it.
Is there a tax implication with gifting?
Okay, so that's a good question. If you're over 60, no. Because in any money that you take out of super, whether it's a lump sum or pension, it's tax-free. All right. Remember how the laws have changed back in 2007? You know, before then used to be reasonable benefit limits and all this other top jargons. But Costello is the one who made that law that if a person who's aged 60 or more can receive their super tax-free. All right. But if you 55 to 60, because you can start taking your money out as a super as a transitional to retirement pension once you reach preservation age, which is really well, you have to be at least 55 to receive some money out of your pension. But that depends when you were born. If you were born after 1960, that preservation age increases by each year, 1 year. All right. So, but if you were born before 1960, the age is 55. So, if you only receive a transitional to retirement pension and you're in that age bracket 55 or 60, well, you can't draw monies out of super as a lump sum. You only can draw out that 4% minimum or 10% maximum. But if you retire in that 55 to 60 age bracket, you can take out all your super if you want, because you've retired. All right. So that's what we call a condition of release. Conclusion. I think that's self-explanatory. No body circumstances are the same. There's no one option that fits all circumstances approach. So, and the best scenario to fit the needs of all members of the fund and the beneficiaries. So, estate planning, which may include binding death nominations and order reversionary pensions, would require proper and regular review. So, it's not like in the old days you do a set of documentation and. For example, I've come across many people who've done their wills 20 or 30 years ago. You know, they think it's enough, but they're forgetting that circumstances change when they start having, say, self-managed super funds that's got created along the way, family trusts, companies. Well, that will that you did 30 years ago is pretty much useless because you've created all these other entities. You know, when you create companies, you're creating shares in those companies. Who's going to own the shares? Because whoever becomes a shareholder of your entities essentially will be the controllers of your companies. And if those companies owns properties, well, they essentially control those properties. Or businesses, for that matter. So, I hope I sort of gave you some bit of info, and the whole point of this session is really to get you thinking more.